Hare Krishna. Once again, welcome to my channel, Purposeful Prosperity. As you all know that we are going through trying to extract the wisdom from the little book of common sense investing and continue with our reading. We are today now going to focus on chapter 5, named as Focus on the Lowest Cost Funds, and where they are trying to explain that more the managers take, the less the investors make. So let's just understand what it is about. So mutual fund selection criteria. So in general, there are two major selection criterias. The first one, which is getting used mostly by all retail investors, is that fund past performance. And we really have to understand, and the common sense tell us that performance comes and goes. And while the past performance tell us that what happened, but it cannot tell us that what will happen in the future. That's really important for us to understand. And I think all the mutual fund ads or the documents, everything is saying the same thing, but then nobody is paying any attention. Just like on a cigarette butts, where it says that smoking kills, but nobody cares about that. And the last part is that this emphasis on fund performance is not only not productive, it's actually counterproductive. Because the fund which is having the best performance, that's where all the fund is flown. And when they have so much of fund to flow, they do not know where to allocate that fund in the best possible ways. Their productivity decreases. So it's a counterproductive thing. That is really we have to understand. So this selection of the past fund past performance is definitely not the best way to select the mutual fund. What's the second way? So second way which Bogle talks about is the cost of the equity fund ownership. That should be the second criteria, which I think nobody cares or look into that thing. Most of the people look into the past performance first, and then if there are some wise investors, they pay a little attention to the second thing. But Bogle is trying to say that the cost should be the first criteria actually. So your cost of your mutual fund ownership is normally the expense ratio, which tends to change a little over time. Mostly it is going to remain same. A low cost fund is going to remain a low cost, and a high cost fund is going to remain a high cost. These costs goes on forever. And with the past long data, in fact, the Morningstar has concluded that the higher costs are associated with lower returns. Because once again, we have to understand that it's a zero sum game. So you cannot have more than what market has given. And if you subtract the cost, definitely your returns are going to be lower. Then second, it has this cost of purchase and sales of portfolio securities or the turnover cost. So here also the studies suggest that the fund in the lowest turnover quartile has consistently outperformed those in the highest turnover quartile. That's very important. And Bogle is saying that this can impact between zero point 0.5 to 0.1%. And then you have some sales charges. I think nowadays most of the mutual funds don't have the sale charges, but if they have some, definitely this can be additional cost for you. So if you look at the first two cost, considering that both the cost of expense ratio and the turnover cost, we find that all the annual cost of actively mutual funds is ranging from 0.9% to 2.3%. That's a very high number. So don't just look at only expense ratio, look at their turnover cost also. If you are not looking at the turnover percentage, my guys, I think you are really missing some hidden cost, and that's something you're not aware of. So pay attention on both these things. So as this cost increases, so does the risk also. So using the volatility of annual return as a measure of risk, we can see that the lowest cost fund carries significantly less risk than their high cost peers. So here Bogle is trying to present a data of 25 years. That's really a long data. And he is further saying that he can include only those funds who survive those 25 years. There are many funds that don't even survive for that long period. Either they get shut down or they get merged with something else. So that's also very important. So that's called survivorship bias. So if we include those funds also, then this result will be more bad for those funds which are charging high cost. So surely fishing in the low cost pond should enhance your return and by a wide margin of that. So cost really matters. So if you look at this data, I think they have been divided into four quartiles, starting with low cost, then slightly higher, more higher, and then the highest cost. And here you can see the gross return earned by the lowest cost fund is less by 0.3% than the highest cost fund. But then if you include their expense ratio, the turnover cost, then you can see that from zero point 0.9, which is on the lowest cost, it can reaching up to 2.3%. So your net return are reduced for a highest cost fund. In the lowest cost fund, it was 9.4%, but in the highest cost one, it was 8.3%. And considering the risk also, if you take the lowest cost funds are taking 16.2% compared to the 17.4% of the highest cost fund. So your risk adjusted return of a low cost fund are much better compared to a highest cost fund. And if you look at this 500 index fund, you will see your gross returns may be lower than compared to all these cost fund. But if you look for the risk adjusted return, that's highest among all these quartiles of the cost. So why stick with then only the lowest cost fund? Go for the index fund, and that's the best way to play a winner's game. You look at the risk here and the risk adjusted return. That's very important. I think retail investor focusing only on the gross return or the net return. Nobody's fake focusing on that just to get this thing, how much of risk you are taking. What are your risk adjusted returns? And that's these two are the very important points to select any investment vehicle for yourself. Then in one of the Morningstar analysts has given some conclusion based on his long reading of or managing or giving ratings to all the funds and everything. So few of the things which he's concluding is that if there is anything in the whole world of mutual fund that you can take to the bank, it is that expense ratio help you make a better decision in a single time period, in every single time period, and data point tested, low cost fund beat the high cost fund. See the morning star analysis which are having the maximum data available with them. And I think retail investor like us, we visited these kind of a sites just to get some idea which is the best performing fund, and we invest in them. When when they itself are saying based on looking at their data with every single time and the data point tested, they are saying that the low cost fund are better. So he's further saying that expense ratio are strong predictors of performance. You look at this statement. See, you can judge the performance based on the expense ratio. So lower the expense ratio, better the performance in a long term. So in every asset class over every time period, the cheapest quintile produce higher total return than the most expensive quintile. Investors should not make expense ratio as primary test in fund selection. In fact, it's saying that should make expense ratio a primary test in fund selection. And what we were looking only the past performance. They are still the most dependable predictor of performance. Start by focusing on fund in the cheapest or to cheapest quintile and you will be on the path to success. So maybe the lowest cost one you select or a little higher than that you select, but don't go for the highest quartile. The first two quartile will be still fine, but don't go for the higher one. That's where you are going to reduce your returns, your performance. And finally, he's concluding that if investor could rely only on a single factor to select future superior performer and to avoid future inferior performance, that factor would be fund cost. So look at this thing. These points are really revealing us very important things that we retail investors should always focus on this expense ratio and not on the past performance. This is an strong predicator of performance and we should be always considering this thing. And Bogle is saying that expense ratio alone is not sufficient. We have to also include the turnover cost. So if you are persuaded by this powerful affirmation that yes, cost matter and decide to focus on the lowest cost group of funds, then why limit your search to actively managed fund? Bogle is saying that traditional index fund has the lowest cost of all. So first of all, he has given us a sufficient data of 25 years where he is trying to convince us that our lowest cost funds are better than the high cost funds. And if you are really convinced with that data, then he is further advising, then why not go for a traditional index fund? Because you don't know out of this lowest cost fund which one is going to perform better. So it's advisable to go for the index fund then. Bogle is further explaining that the more the managers and brokers take, the less the investors make. And if the managers and brokers take nothing, the investor receive everything, which is the market return, your fair share of market return. Then Bogle, in one of his quotes, he says that don't look for the needle in the haystack, just buy the haystack. So let's just understand what he's trying to explain. So here Bogle is saying that selecting the index fund eliminated the need to search for those rare needles in the market haystack, represented by a very few active fund that has performed better than the haystack, in the often vain hope that their winning ways will continue over decade yet to come. See, first of all, three important points which he's trying to explain here. First of all, we have from the data, we have to be really convinced that low cost funds are better. Second thing, he's saying that out of these many low cost funds, only a few active funds which are going to perform better. Because definitely m- at the end, it's a zero sum game before the cost. So if some mutual funds are performing better, there are others which are going to perform worse also. So you will not be able to figure it out in the beginning which one are going to perform better. Looking at some data of some 2 year, 5 year. It's a long data of 25 years. And for Bogle, investing is about some 50 years of investing. And if you look such a long data, then definitely you cannot predict. So he's saying that why to go in that path of selecting those few active mutual funds where you are not sure which one is going to perform better. It's often good that we start investing in the index fund. So that way we are making sure that we are always going to get an average or above average return from the market. Then we have the CNBC business anchor, Mr. Tyler Mattison. He is trying to explain three real advantage of the index cost fund. So where then the first advantage he's saying that we really have low expenses. So your annual expenses are really low with the index fund. Why the low? Because they have the lower expense ratio. And second thing is that he's saying that they keep turnover to the minimum. So their turnover ratio will also be minimum, then their turnover cost will also be minimum. So it's more of a buy and hold strategy. And from the Warren Buffett, we understand that that's the best way to get the maximum benefit. And moreover, because this index fund manager convert paper profit into realized gain less frequently than to the skippers of actively managed funds, shareholders pay less tax every year to Uncle Sam. And the third point, he is saying that since index funds are converting these paper profits very less frequently, so your buy and sell is happening less. So once again, your turnover cost is reducing, and many other costs which are associated with this buy and sale. So with all these three advantage, he's saying that these three combinations are these trios are impressive, and this is the advantage of the index fund. So CNBC anchor is also giving so much of weightage on the index fund because considering that his vast experience, he can really see how market are working compared to a retail investor who just started investing in 2 years or 5 year time frame. So we should try to extract the wisdom from such intelligent people. Then further in the chapter, Bogle is saying that indexing should form the core of most investor fund portfolio. So if you don't agree with this indexing, the passive fund or the active investing, but you really have must accept that the passive investing must be core of your fund portfolio. You cannot ignore them at any point of time. The Bogle is saying that gunning for the average is your best shot at finishing above average. So let's just understand what he's trying to explain here. So he's saying that settling for average is good enough, at least for a substantial portion of most investors' stocks and bond portfolio. So aiming for benchmark matching returns through index funds assure shareholders of a better than average chance of outperforming the typical managed stock or bond portfolio. So this is the paradox of fund investing. So if you really want to perform better than the average, then you have to stick with the index fund, a low cost index fund. And that's the way to make wealth in the stock market. So once again, thank you for being with me. I hope you really get something out of this video and you really understand and convince yourself that the low cost index funds are better for in fund performance. So if you really like this kind of content, if you think it's making some values in your life, feel free to like, share, and subscribe to my channel Purposeful Prosperity. I will come back again with a summary of the next chapter soon. So thank you everyone. Hare Krishna.